everybody sticking around for this discussion. It's going to be me and my colleague Simon Bogdanowicz should be here as well. We're talking about VC investing in the new normal. What is it? What does it mean to be in a recessionary and deflationary era right now? And how should companies navigate the waters? But broadly, this can be an open forum discussion with anybody that has any relevant questions. You should feel free to put that in the chat, and we can definitely touch on them. For context, and I'll let Simon go into his background, but we both are part of a Gravity Group, and we provide advisory and are also a venture fund focused on a lot of early stage technologies, and especially where they meet the nexus of purpose-driven and impact and sustainability-driven companies as well. But Simon, I'll let you elaborate on anything you want to share about your background.
Yeah, no, thanks for that. Can you hear me okay, by the way?
Yeah.
Okay, great. As you can see, I'm taking this from my car being displaced by the pandemic in multiple ways right now. Yeah, so my background, like Nish, I started off at working at the World Bank of Canada in mergers and acquisitions, and since have led pretty interesting professional career. So over the last 13 years now, I've worked between Wall Street, big enterprise tech, SaaS sales, software as a service sales, into the Fortune 1000 for outfits out of New York City and Silicon Valley, including Thomson Reuters and some major marketing platforms. And then took an entrepreneur journey in 2016, leading a couple consulting firms focused in on startups, most recently startups and early stage businesses enabled through emerging technologies before working with Nish at Gravity Group. So I think between the both of us, we have very, a lot of comprehensive knowledge from our past professional careers and also the present times today in terms of VC investing, M&A, just the changes in the world and what's going to, what the future is going to unlock in the next 6, 12, 24 months and beyond, years into the future. So
Yeah, absolutely. And for anybody that's showing, we're going to make this a back and forth discussion, but people are welcome to post commentary in the chat that we can touch on. But yeah, so Simon, what do you see as the timeline for the way that we're gonna come out of this, both in terms of early stage startups closer to the seed Series A stage that we typically interface with, as well as some of the later stage startups that might have been backed by pretty aggressive investors like SoftBank that were at the tail end of kind of reaching for liquidity, whether that be tapping public markets or searching other forms of late stage capital. How do you see the timeline around what's going on from a health and pandemic perspective playing out over the course of time for various startups?
Yeah, and I think it's great. Just like any kind of world-changing event of any kind, whether it be, driven by a health crisis or driven by a financial crisis or something else, I think we're going to see a lot of everything just really accelerated, right? I think we're going to see like a lot of startups that will fall away, that haven't put into place commercialization strategies yet, and also don't have the capital to pull through, and then they're at the same time having a hard time investing or raising money from investors. And then we're going to see other companies that are shining at this time and having investors flock to them. So going back to your first part of that question in terms of the timeline of the pandemic right now, as anyone can turn on the news and see, timelines are really all over the place, right? Some are saying we could have a vaccine as soon as at the end of this year. Others saying like we may never see a vaccine, or we'll need multiple vaccines, over multiple years, things like that. So, it's a very cautionary tale of looking at, what the future holds, but at the same time understanding, at least from the information we do know, how are we going to be able to, in all countries around the world, going to be able to open up safely, and do it in a way that, do it in a way that doesn't push us backwards in time of causing a real, true, like large second wave, or having it be larger than the first wave, like the Spanish flu pandemic in the early 1900s. That being said, like how companies are tying into it, I think we're going to see a number of down rounds, for companies that have already raised, that are looking to raise their Series B, and down rounds as in, and I say that even potentially for those companies that may be a good fit for capitalizing on the current pandemic, that are in like health tech and digital tech, whatnot, just because valuations have been so frothy, over the last several years, right? You look at WeWork, you look at others. And so I think, in times like this, people look back at their capital, how it's working for them, and still looking at the, kind of, channeling back to knowing what they're best at, what their VCs are looking at, their current operating companies, making sure that they shine through and don't fall apart. But when they're looking at new investments, they're really honing in on only focusing on their investment thesis and not on other areas that may have been kind of nice auxiliary areas that they would like to have investment in, but they don't have any expertise in, from an investing or a professional experience, accelerating standpoint, or working perspective. So I think it's more of a kind of back to basics on that. The areas I do like, obviously, anything, that I think are going to stand out is anything with health tech, not anything with health tech, but certain areas of health tech, med tech, telehealth. I think we're seeing obviously a boom of a lot of the gaming stocks, and especially esports. I think esports are really this is like really their time to shine, as well as elements that touch cybersecurity and privacy, including those companies that are blockchain enabled or have or working, in the DLT space, digital, distributed ledger technologies, as well as, anything basically contactless, right? Which can include, digital banking, various, fintech elements, and also how to make life easier, more convenient for you and safe, right? So you're seeing valuations increase, and food delivery, Instacart, Grubhub, you kind of name it. Even communications like Zoom and others. Some of these will survive and thrive through the end of the pandemic, when we do feel like there is a viable way to say, hey, we're nearing the end, or we know what that may be. Others are kind of a staple for the now, but I think they'll be, they will not be able to just hold up the times beyond this for one reason or another, because another incumbent's, taking their market share and they don't know how to fight back, or they might be acquired, or something else. So it's, everything's accelerated with the current pandemic, across the board, including the use of digital services, and generations now looking at, saying, hey, tell me how to use PayPal. Hey, tell me how to not go to the bank to cash in a check and whatnot. Or like, hey, you have Netflix, and then asking their grandson, like, tell me how I can use Netflix and watch something else other than cable TV. So it's very accelerated timeline across the board. But at the same time, I think it's important to know, at least on a personal level, I feel a lot of people don't want the pandemic to also transcend into having greater control over the population and taking away from our own personal civil liberties, wherever in the world you are, as a citizen. So I think it's going to be a careful balance to managing that as well, especially as more people share information online, and interconnect all the different lives into like a single kind of like digital persona, if you will.
Yeah, no, agree with all those points. The piece on down rounds definitely makes sense, given that companies are really going to be shifting to survival mode, like you said, focusing on their core competency, really focusing in on what do they need to focus their resources on to be able to weather the storm here, so to speak. And certainly the trajectory is accelerated for a lot of business models, whether that be a push from a healthcare and regulatory perspective. We're seeing, even within Gravity, a lot of traction for businesses like at-home testing kits.
Yep.
And so I'd kind of bucket the two accelerants in kind of a B2C side and also like a B2B side. I think there's a lot of B2C businesses that are going to be accelerated, like you mentioned, gaming, esports. More people are spending time at home. More people are stuck at home, just trying to find ways to either entertain themselves or pass time, or find ways to more efficiently digitally communicate. And then on the other hand, you're also seeing quite a lot of acceleration in automation technologies as well as technologies that can lead to productivity gains, whether that be from an enterprise perspective or even productivity gains that you can see from enablement of work from home tools that we're also seeing a lot of traction in. So as you think about the medium to longer term timeline around some of these trends that we're seeing, how do you think this is ultimately going to play out in an M&A landscape? What trends do you think are going to be more temporary, and how do you see that those more permanent trends being able to stick around and proliferate even beyond the kind of window of lockdown and quarantine that we've been seeing lately?
Yeah, no, it's a good question, and I definitely want to get your commentary, thoughts on this one as well. I think now, like, kind of based on everything we're seeing, what I'm hearing, also that's not in the news, we're seeing like definitely a pickup of we're going to see a pickup of M&A activity, but very selectively, and then and that M&A activity is going to have to be kind of diligence more than ever by executive teams and boards to make sure it's a great fit that's going to either create a new competitive advantage or just strengthen the competitive advantage and the economic moat of a company to protect themselves during this time. So that being said, to be honest, I think overall, just in general, M&A activity is going to be down, across the board, other than for those companies that can afford the M&A activity. And so like that being said, what I mean by afford economic activity or M&A activity is that like those companies that have like, healthy balance sheets that or that have like creative ways to structure M&A, whether it be through some kind of rev share, licensing models, or some creation of a new company that another company goes into a JV partnership with, that you could consider, kind of quasi M&A, quasi new joint venture. So in the short term, or let's say like during kind of stay at home or during just the pandemic in general, I think we're going to see the more M&A activity in those areas that are really thriving, or those areas that are really suffering right now, right? So that being said, in terms of suffering, I think anything to do with travel and leisure, that could be a hot spot for M&A activity. Pick up companies on the cheap that have viable teams, viable assets that just don't have cash flow positions to maintain. They may be over leveraged and whatnot. or they may be going bankrupt, right? I think M&A activity might be coming in from bankruptcies in the retail space, right? We're seeing even JCPenney going to be announcing soon, I think, a bankruptcy. We've seen others over the past few weeks. I think I personally think we're going to see a M&A, or some kind of bankruptcy in the airline corridor industry, and might be some M&A pickups. So there'll be consolidation in those areas that where companies are viewed as cheap, and also those areas where there's a lot of promise, and companies want to get into it. So I can see, Google and Apple and others that have pretty healthy cash balances acquiring companies in telehealth, or acquiring companies in med tech and EHR, electronic health record systems, and things like that. We're already seeing some of that, but I think we're going to see more to come. And so that's, I'd say, in the short term. In the long term, I think some of the acquisitions, like M&A, will happen, once people kind of get back to a steady state of things, what the long-term new normal looks like. I think we'll just see more interest in emerging tech in general, in the spatial web, right? Gravity worked with a company called Versus, which is actually could be a key player in creating the Web 3.0. And in other areas, I think there'll be this acceleration for emerging tech. I also think there'll be consolidation, not only in industries, but also in nation states of companies saying, hey, we cannot be at the whim of having too much of our supply chain for pharmaceuticals be based offshore, whether it's in Vietnam or China or somewhere else. And so we'll see, I think, more nation state companies, or companies like within the US acquiring other companies within the US or Canada, or like just border countries, versus going overseas too much, just to make sure there's just because of the heightened sense of awareness of the importance of being able to not cut off potential supply chains or services in case there is some kind of economic warfare or economic rebuttal between nations, during and following the pandemic, which a lot of economists are saying may happen as well.
Yeah, no, I'd agree with a lot of that. I mean, to the points of the various industries that are going to be able to proliferate through this time, and those that are going to go bankrupt, like airlines, like you mentioned. I think a big question mark right now for a lot of investors is, what is the ultimate role of the Fed gonna look like? What is the ultimate role of the Treasury gonna look like? Where are they gonna play? How are they gonna structure their deals? Right? I think there's a debate that's been going on of the best way the Fed should approach some of these problems, and really provide aid in a really capitalistic market, right? I think you're seeing investors like Warren Buffett back away from investing meaningfully, because the Fed is coming in and stepping in and playing the role that he would have otherwise played in providing liquidity. But the fact that they've been doing so, basically in giving away free money, makes it very challenging to be competitive on structuring an actual deal. So I think there's been a lot of proponents of the Fed coming in, but injecting liquidity in ways that has competitive market bids along with the rest of just the capitalistic market, versus coming in and basically providing this free money and this injected liquidity into various industries, which some critics could argue props up underperforming companies and underperforming CEOs, in ways that just exacerbate a problem as opposed to actually put a solution on it. How do you kind of think about that? And there's no right answer, but what do you think about the role that the way that the Fed has been enacting a lot of the monetary policy to date, and where you think that should either extend to or be limited to going forward into the future?
Yeah, no, that's a great question, and I know we're running on time. We talk about this for hours as well. Yeah, just real quickly on that. I think that I personally think that I've been really shared a lot of the same sentiments previously as Ron Paul, the libertarian who wanted to not necessarily end the Fed, but at least audit the Fed. I think there's a lot of mystery behind the Fed and what it does and what it does not do, and how it controls, how it interplays into the government, right, as its own its own separate organization. So that being said, I lean more so as in I think certain the Fed, for us not to fall into a market that is 40-50% down right now, may still be at that place here and now. I think the Fed had to step in some way or some shape or capacity, and that's kind of what they say the Fed is built for, right, to help with the fiscal responsibility and things. But at the same time, looking at QE infinity, quantitative easing infinity, and being able to print what they're calling now helicopter money, I think overall it's really unhealthy for the balance sheet of the entire country. It's putting us in a place by 2030. I read that the amount of interest the government has to pay on the debt is going to, if not equal, then surpass discretionary military spending, which we already know is very high in the U.S. And then if you throw in the possibility of negative interest rates by the end of this year or beginning of next year, or something else, which right now I know it's being discussed as not being looked at, but you never know, anything's possible. I think we have to really tread lightly on that. Just like a lot of policymakers and like a lot of economists and just investment managers are saying, we can get into this hyperinflation mode very quickly, while at the same time, we might have to the Fed might have to institute some measures to go into a deflationary period. We've just seen record prices for food, right, since the tracking of food prices in terms of a percentage increase over the last 2 months and things like that. And obviously that exaggerates the problem and the issues that a lot of America is suffering, especially those that are living at or below the poverty rate, or the paycheck to paycheck population, things like that, which is suffering even more. And now you're seeing this great divide and across politics. Should we go into universal basic income, or do some kind of stimulus check, or reopen faster the economy, but do it, as we know, at the expense of lives lost? But so weighing all those in a balance is something that no one has a real answer to, right, as we learn more and more information. But I think overall, the Fed should really tread lightly, I think, for the current and future generations of America, because the money, if the whole world goes into a quantitative easing infinity situation, I think the whole world will have to come together and just write off massive amounts of their own debts that they've written. Otherwise, and that will cause power struggles between nations and whatnot. So we'll see how it unfolds, but it's a careful balance.
Yeah, no, definitely agreed. I do have one other question for you, but did you have any other questions that you want to ask that you think we should touch on this call?
No, I mean, I love the back and forth with you. If you have any thoughts also on the Fed, would love to hear those.
Yeah, I mean that. So I mean the Fed right now, I think is I think doing exactly what it should be doing. I think what I wonder is the sense of optimism that a lot of investors have been taking away from some of its broader kind of sentimental comments shared around their willingness and ability to play in a meaningful way. And I think it's largely a function of how much longer we're going to be forced to stay at home. I think if it's and the issue is that um, we are making decisions that will ultimately lead to a very inflationary and very inflationary outcomes while we're in a very deflationary environment. And so, right now, all the liquidity that's being pumped is really being soaked up, and so it's really hard to tell, a year, 2 years, 3 years from now, how that's going to end up playing out on the basis of inflation. And if things end up lasting another 6 months, 12 months, then that could have very severe, potentially decade-long implications
Mm,
on some of the issues that we'll face from an inflationary perspective. And you look to countries like Japan, and what we don't want to risk is running into a stagflation scenario. Um, Real quick before we end, wanted to ask as well, what are your thoughts on Bitcoin right now, just
mm.
as a store of value, as a currency, as a macro hedge? How do you think about it? What are your thoughts there?
Okay. No, it's a great question, and I always love to talk about that. Definitely want to isolate Bitcoin from all the other digital currencies in this conversation. So this is not like a blanket statement by all means, by any means. I think I personally think it is a great hedge. We're starting to see the decouple of Bitcoin from the stock market, which is a great sight to see. I think more than anything, it's probably still viewed by many as a store of value, volatile store of value, at least in the short term. But in the long term, I'm seeing more and more people. I have a nice network of family offices that are looking to put in percentage of their capital, even 1 to 2% of their overall family holdings into buy and hold positions in the Bitcoin for long term. And by long term, I'm saying minimum 3, minimum 5 years at least, versus and of course there's going to be swing traders trading the day to day, but I think by all means, with even last month, the U.S. government, I think House Democrats presented in a bill the proposal of a potential U.S. dollar digital currency that was going to be looked at during, I believe it was the first stimulus check, or was the first stimulus package that we had going since the real great arrival of the pandemic here in the U.S. And that right there just showcases the interest that we're seeing at that level. And I think more recently, a few days ago, JP Morgan said that they're going to start servicing a couple US based exchanges. I think it was Gemini, maybe Kraken, or one other, and working with them. So that goes a long way from what Jamie Dimon was saying a few years ago about Bitcoin and blockchain in general and cryptocurrency, and writing it off. So we're seeing institutions coming in. We're seeing family office interest, family offices wanting to come in and have exposure. A lot of people are, like, I think those that still have capital to work with are seeking alpha in many different places, not finding it. And they see the world going into, the possibility of digital currencies, staying around, but still seeing Bitcoin as more so a hedge and a store of value, more so than being a means of transacting, at least at this time. And so I think we're going to continue to see that more and more. I believe that they're still going to be volatile. There are still large players that can make huge swings in the Bitcoin market, just in the flick of a trade, which which, definitely raises a lot of flags from a volatility standpoint. But I think, based on what you're seeing in China with the potential digital currency and the yuan and everything else, and the yen and everything else, that that companies, not companies, but governments are going to start thinking about, hey, should we have our own, digitalized currency, especially during a time like this? Is a good time to really dig in and double time and think about it, where, kind of having, paper currency, is not necessarily sanitary and clean, but also it's not really needed in our, in the current world, and definitely not in the future world as we see it. So digital currencies are going to play into it. I think Bitcoin is going to play a big piece of it, big part into it. And it, definitely started the, everything really follows Bitcoin for the most part from a price fluctuation standpoint. So when you see Bitcoin jump 5%, and it holds at that level, typically you see still like the top 10 currencies kind of move along behind it, but do it with Bitcoin being, much of the lead of the market, and still maintaining a 66 to 69% dominance in terms of market cap over the entire market. So I think that's going to go down. That might go up a bit. We'll see. I think that's going to go down as other kind of top 10 players come about that are actually backed or partnered with major VCs like Horowitz, or major companies like Google, things like that.
Yeah, absolutely. Well, I think we're coming up on the top of the hour here. So yeah, thanks, Simon. Glad we had this discussion. Enjoyed it.
Yeah, man. It's always great to talk on this, and happy to do it again.
Awesome.